Hey all, it's John from StopSaving.com here, and welcome to this free introductory video of our course, Technical Analysis Simplified. In this video, you'll get a basic overview of technical analysis, which will highlight some of the core concepts that this course will focus on in a lot more detail later on. As for this video, we'll start off by answering the obvious question, which is, why study technical analysis? We'll then move on to some of the theory behind technical analysis before finally wrapping things up with 5 case studies using real price charts to show what technical analysis could potentially do for your trading or investment strategy if used correctly. So without further ado, here's the first video. So here's what you'll learn in this video. Number 1. What technical analysis is and why it's essential to any trading or investment strategy. 2. The 2 questions that technical analysts must answer to be successful traders. 3. How technical analysis relates to buy and sell pressure. And finally, number 4, what technical analysis can do. Later on in this video, we'll go through 5 case studies to show its true power. So let's start off with an important question, which is, why on earth would anyone want to study technical analysis in the first place? Well, this gentleman right here came up with a compelling reason many years ago. His name was Bernard Baruch, and he once said, "Show me the chart and I will tell you the news." You see, a price chart contains more information about the state of investor sentiment than any news article ever could. But to truly get a grasp of what price charts are telling us, we must first know how to read them. That's where technical analysis comes in, which I like to call the language of price charts. Bernard was a legendary American investor. He made millions in the 1920s bull market and then shorted stocks right before the 1929 crash. So as you can imagine, he did pretty well for himself. Bernard used simple price lines to chart daily moves. Today, we have way more tools at our disposal. One of those tools is TradingView, and in the final section of this course, I'll give you a full breakdown on how to use TradingView effectively in your own analysis. Technical analysis operates on the principle that all news and information about an investment is reflected in its price chart. And let's face it, it's much easier to read a price chart than it is to sift through all the news. So let's now come up with a simple definition of technical analysis, or if you want to keep it brief, it's TA. So if you had to ask me to describe TA in one sentence, there are essentially 2 ways to do it. The first is the classical definition by Investopedia. Technical analysis is a trading discipline employed to evaluate investments and identify trading opportunities by analyzing statistical trends gathered from trading activity such as price movement and volume. Now, this is a good definition and it effectively explains what TA is and what it's used for. But as is the theme of this course, we're really trying to simplify everything we do. So here's a simpler definition of TA. To analyze an investment's price chart to make an educated guess where the price might go next. Now, I've emphasized the word guess here because nobody can predict exactly what prices will do next. But by using technical analysis, you're at least making an educated guess rather than flipping a coin. At any point in time, a technical analyst should be asking themselves 2 simple questions. Now, I've put simple in quotations here because, truth be told, they're not always that easy to answer. But by using technical analysis effectively, you'll have a much better chance than most. So, here are the 2 questions. Number 1, is the price more likely to change direction or keep going in the same direction? And number 2, is the price move slowing down or speeding up? i.e., is the trend getting weaker or stronger? As you'll learn throughout this course, technical analysis will give you the framework you need to answer these questions as best you can. Learning technical analysis can give you a serious edge in trading. It can help you identify trends, determine entry and exit points, and manage your risk. It can also help you understand market psychology and the forces that drive price movements. In fact, by understanding technical analysis, you'll probably be better at forecasting market moves than most well-paid professional fund managers and analysts being interviewed on Bloomberg and CNBC. Now, I don't say this lightly. Even though most professionals are brilliant at understanding the fundamentals like macroeconomic data or a company's balance sheet, they don't all use TA to monitor price action. But at the end of the day, it's price action that matters most, and TA is price action. You see, the markets don't always move in line with their fundamentals. The price of an investment at any point in time is simply the result of buyer versus seller pressure. And by thinking in terms of buy and sell pressure, TA will start to make a lot of sense. So that now brings us to the next important question, which is, how does buy and sell pressure affect the value of an investment? Well, it's pretty simple. When there's more buy pressure, buyer demand is greater than seller supply. Price goes up as buyers are willing to pay more to outbid other buyers. When there's equal buy and sell pressure, buyer demand and seller supply are in equilibrium, and the price stays flat or stable. And when there's more sell pressure, that means seller supply is greater than buyer demand. This causes the price to go down as sellers compete with each other to offload their investments as fast as they can. So now that you know what technical analysis is in theory, it's time to see what it can do in reality. And the best way to do that is to use real case studies and look at different price charts to show examples where technical analysis could have been very good at helping you time market tops and bottoms, and at spotting big changes in investor behavior. So I'll now run through 5 different case studies with different assets and different situations. Don't worry if these concepts seem a bit advanced right now, as we'll be building on them much more in later videos. For now, these case studies are just to give you an idea of what technical analysis can do. So here's the first case study, and we're starting with none other than Bitcoin. Specifically, we're looking at the Bitcoin top of April-May of 2021. And I'm looking at the BTC USD one-day chart in TradingView. As it's a one-day chart, it means each of these red or green bars represents 1 day of price movement. These are also called candles, and we'll go over candles in a lot more detail in a later video. For now, let's focus on what's going on with Bitcoin. You can see that from late 2020 until early 2021, Bitcoin had this massive run-up in price. It went from about $10,000 a coin all the way to about $60,000. This blue line over here is the 50-day simple moving average, or SMA. You can see how it was sloping upwards and supporting Bitcoin's price during the rally, with buyers stepping in to buy Bitcoin each time it tested the 50-day moving average. We've got a whole video dedicated to moving averages later on, but for now, just know that this moving average is simply the average of Bitcoin's price over the past 50 days, and when Bitcoin was trading above this line, and the line had an upward slope, buyers were in control of the trend. But then something changed in April 2021. For the first time in a long time, Bitcoin finished the trading day below the 50-day SMA. Now, this didn't necessarily mean the bull market was over, but it was an early warning sign of a change in investor behavior. This time, buyer demand was weak at the 50-day SMA, and the price dropped quite far below it. Then came the next sign of buyer demand getting weaker and seller supply getting stronger. Bitcoin made its first lower low of the entire bull run that was also below the 50-day SMA. An uptrend is made up of higher highs and higher lows, and now that there was a lower low in place, the uptrend looked like it could potentially be about to turn into a downtrend. Of course, to have a downtrend, you also need the price to make a lower high. And that's exactly what happened over here in May. The price made a lower high and also dipped back below the 50-day SMA again. The slope of the SMA started to flatten out too. These 3 warning signs would have been enough for a focused technical analyst to consider selling their Bitcoin and wait for prices to go lower, which they certainly did as Bitcoin dropped all the way down to about $30,000 over the next couple of weeks. So moving on to the next case study, and here we have the S&P 500 and its turnaround in late 2022. This is ticker SPX in TradingView, and I'm using the 1-week chart. That means that each red or green candle represents 1 week of price movement. So as you can see, the market topped out at the start of 2022, and the price trended down until the low in October that year. And here you can see that the price made a lower low in October than it did in June. Now, lower lows are typically bearish and show that sellers are still in control of the market as they're able to push the price down to lower levels. But on the bottom, you'll also notice this blue line. This is the Relative Strength Index, or RSI. Now, we'll cover the RSI in detail in our indicator section of this course. But for now, just understand that the RSI essentially measures the relative strength of buy pressure versus the strength of sell pressure. And as you can see here, the RSI made a higher low as the SPX made a lower low. This meant that even though the price was trending down, buy pressure was getting stronger relative to sell pressure. So put another way, the downtrend was running out of steam. We call this a bullish divergence, and it's something we'll cover in a lot more detail later on in this course. Now, you might remember that everyone was bearish on the economy and inflation at this time, with many fundamental analysts calling for a big recession and much lower prices on the S&P as a result. But by looking at this simple price chart using technical analysis, you would have had good reason to not buy into that bearish sentiment and potentially buy into the S&P 500 instead. Now, this next case study is quite an interesting one. It shows why the pound never reached parity with the dollar in late 2022. This is the 1-week chart of GBP USD, where each red or green candle represents 1 week of price movement in the currency pair. Now, if you were living in the UK in 2022, like me, you would have been very worried about the value of the pound. It was going down rapidly, and there was a lot of bearish sentiment, and a lot of economists, analysts, and news commentators were all calling for the pound to reach parity with the dollar, where £1 would be worth $1. The pound was in freefall, and for UK citizens, going on holiday in America wouldn't have been the best idea at the time. But if you were a technical analyst looking at this price chart, in particular what happened around the lows, you would have been a lot more inclined to not buy into the bearish sentiment and perhaps buy into the pound instead. The first thing to notice is that when the price reached its low, it did this very quickly. It's what you call a price capitulation wick. This stick at the bottom at the end of the candle represents what the price did during the week. It doesn't represent where the price ended the week. Now, as an analyst, you want to focus on where the price ended the week or day or whatever time frame you're trading, rather than what happened during the week. Now, you can see over here that the body of the candle closed higher than it did the week before. So even though the price had a big spike down during the week, it still finished the week at a higher price than where it started it. So this was a potential reversal candle. Again, we'll cover candles in a lot more detail in later videos. The other thing to notice is that the candle closed back inside the Bollinger Bands, as in above the bottom band. Bollinger Bands are extremely useful indicators, and I think one of the best indicators you can use if you really understand them. I'll go over Bollinger Bands in a lot more detail in this course, but for now, just understand that Bollinger Bands are a volatility indicator. The wider the bands, the more volatile the investment is at the time. And at the time of that reversal candle, the Bollinger Bands were the widest they'd been since 2016. In other words, the move happened with a lot of volatility. The next thing to know is that there was a massive amount of trading volume on this volatile candle. In fact, it was the most volume traded since March 2020 COVID crash. That meant that a lot of buyers were willing to buy the pound at these lower levels. So to put this all in a language that doesn't involve technical analysis, there was a lot of fear, a lot of panic, a lot of bearish sentiment, and a lot of investors throwing in the towel at the worst possible time. A lot of big traders then came in and bought that panic and quickly reversed the price. This was capitulation, and something you tend to see when the price makes fast lows before quickly reversing in the opposite direction. On top of all that, this was the February 1985 low where it retested as support and it didn't break it. So there were a few reasons to be bullish on the pound after that. The final thing to notice is that the price also tested the bottom of the Bollinger Band and then started to trend up. This was a sign that the bottom band was now acting as new price support. So this is why the pound looked likely to go up despite all the bad press around the pound. At this time, you might recall that Liz Truss was the Prime Minister and the market wasn't liking Truss's economic policies. Rishi Sunak then took over as PM and the market saw him as a safe pair of hands for the UK economy, and the pound continued to rally. But notice that the capitulation happened before Sunak became PM. So this is a great example of how the price is actually leading the news, and as Bernard Barrett would say, show me the chart and I will tell you the news. It also shows how technical analysis can be used for just about any asset with a price chart. Our fourth case study is on Brent crude oil and its double top in 2022. This is ticker UK Oil and it's the 1 week chart. So in late 2021, early 2022, oil prices were on fire. There were many issues going on with global oil supply, and traders were speculating that the oil supply shortage would cause prices to go much higher. And then what happened in early 2022 is you had this blow-off top, where the price reached $138 a barrel with extreme trader euphoria and volatility. Now, looking at the Bollinger Bands, you can see that they were very wide at this time, which basically meant that volatility was very high. This was a similar case to the earlier example with the pound, but this time in reverse. Instead of the price spiking lower very quickly, it spiked higher instead. Notice too how the price wicked far outside the top Bollinger Band, which basically meant this was a very extreme move and pretty much unsustainable. So what happens then? The price drops, and what normally happens when the price drops in an uptrend is that dip buyers come in and they buy the dip, thinking the price will keep going up. Of course, the price did go up, but it went up a lot more slowly than it did the first time. And then there was a second top, but the price only reached $124. And this time, the greed and euphoria from the buyers was replaced by investor complacency. There was a lot less volatility on the second top, given that the bands were now much narrower, and not only that, but the price never broke above the top Bollinger Band. This was another sign that the second top was a far less extreme move. So essentially, the second time around, the price doesn't make a higher high, buy pressure gets exhausted, and sell pressure starts to take over. Now, interestingly, and I'm not having a dig at Goldman Sachs here because obviously they are very smart analysts, but pretty much at the second top, Goldman Sachs predicts $140 oil prices as gas prices spike near $5 per gallon. You see, Goldman analysts were looking at macro factors here, things like geopolitics and industry demand for barrels of oil versus supply. But if they just let one of their technical analysts look at the simple price chart, they probably wouldn't have made that call. That's because this chart was clearly saying that a big reversal was likely in progress. So here's another example of how simple technical analysis is not only easier to understand than fundamental analysis, but is more often than not more accurate too. Price action rules all. Show me the chart and I will tell you the news. And last but not least, here's our final case study. And if you're a gold bug like me, then this one's for you. It's the gold bear trap of late 2022, and we're using the 1 week chart. So basically, gold was in a trading range for quite a long time, about 2 years from late 2020 until late 2022. And you can see this price level of support here, where gold had tested multiple times without breaking below it. Now, as a trader, you want to buy at support, and we'll talk more about that in a later video. But when the price breaks support decisively, that can be a bearish signal because sell pressure gets too strong for the buyers to hold the fort. And that's exactly what happened here when the price broke below support after the summer of 2022. And what would normally happen when support breaks is that more traders will start to short the assets, thinking the price will go down much further. So traders were definitely shorting gold here. And investors who own gold might have sold their position thinking they would be able to get in at a lower price with a better opportunity later on. This essentially laid the bear trap. Everyone who was bearish on gold had good reason to be bearish. But then what happened, and what often happens, is you had what we call a deviation. This is when the price briefly goes below support and then closes back above support. In other words, the bears were now trapped in losing short positions. But it gets worse for the bears. You see, when you short an investment, the only way to exit that trade is to buy back the investment. So as the price of gold started going back up, shorters would have had to buy gold back to exit their positions at a loss. This would have set off a cascade of forced buying, which would have driven the price higher very quickly. It was a classic short squeeze. So as you can see with this example, we haven't used any indicators at all. But by simply looking at how the price interacted with a key level of price support, you'd have had all the information you needed to make an informed trading decision. So that's the end of this first video, and here are the key takeaways. Number 1, all information that the market knows about an investment is baked into its price chart. 2, you can use TA to study an investment's price chart to make an educated guess where the price might go next. 3, you can use TA to study the strength of a trend and help answer the question of, is the trend getting stronger or weaker? 4, you can use TA on any investment so long as it has a price chart. And finally, number 5, TA is good for short-term traders and long-term investors, and we'll get into that in a later video. So that's it for this video. I hope you now have a good understanding of what technical analysis is and how it can be useful in your trading strategy. As I mentioned before, we'll go into more depth on the different indicators and principles you've seen in the case studies on this video. We're only just getting started. In the next video, we're going to explore how big investors buy and sell assets over time. Understanding how the big money operates will put you at a huge advantage over those that don't. So thanks for watching, and I'll see you in the next video.